Good afternoon and welcome to TMC Connect. We'll get started in just a minute. That is where I ask, like, what's your favorite spirit animal? Just to break up the crowd. Hi, and welcome to TMC Connect. My name is Tony Bramley, and I am the Director of Business Development here at the Mortgage Collaborative. Thank you guys so much for stopping by today. We have got an amazing session for you. We are going to be talking about emerging solutions in home equity, title, settlement, and closing with our great preferred partners, Stewart and Theranos. I love it when partners come together and do blended presentations. It's amazing. So we've got just a couple of ground rules here. Everybody is entered in on mute. So if you would like to ask a question, please do so in the chat or Q&A, and we will take those at the end of the presentation. And then there'll be a follow-up email tomorrow, which will include a link to the video for this session, as well as some information for you to review. So once again, thank you guys so much for being here. And I'm going to turn it over to Marvin.
Thanks, Tony. Appreciate it. Really great to be here and joining arms with Theranos to bring some great information around home equity. So let's go ahead and do some introductions. So today our first speaker is Rich Kugler. Rich, do you want to give a short intro here?
Sure. Thanks, Marvin. Good afternoon, everybody. I'm Rich Kugler with Stewart Lender Services. I've been working in the industry for 25 or so years. I've been with Stewart for about 9 years, and I'm responsible for the business development team here at Stewart that works with lenders, including mortgage origination, servicing, capital markets, and the area we're talking about today, home equity lenders. Happy to be here, and thanks very much.
Perfect. Thanks, Rich. Ken?
Well, good afternoon, everyone. Thank you to TMC and Stewart Title for the partnership and having us on. My name is Ken Flaherty. Been working for Theranos for about 2 years, and prior to that, worked for a large regional bank for about 15 years. And really, in a nutshell, what I do at Theranos is I work with lenders, depositories, credit unions, just like yourself, sitting in similar seats and really leveraging real-time data assets in the home equity world to help better make strategic decisions for your line of business.
Great, thanks, Ken. And I'm Marvin Stone. I'm going to be moderating today's session, and I serve as Director of Strategic Initiatives for Stewart Lender Services. So I work alongside Rich and with a lot of our partners, and so I'm happy to get us started today. So with that, we're going to ask the first question, and the first question, really, I'm going to start with you, Ken, is, rates are up. It's no secret the environment is challenging, and lenders are had to pivot away from refinance. And we're obviously here to talk about home equity, but what are you seeing? I know you've got a slide here we're going to talk about, and that kind of gives some of the answers there.
Yeah, so this is a really interesting viewpoint where it's not necessarily looking at volume, which I'll provide some commentary as what's happening in the market, but this is a historical quarterly view where on the top, you're looking at the rate distance to what I would say from a home equity perspective is the competing products, which is going to be your cash out mortgage refinance. So kind of consider that the par rate in that black line, whereas that purple and teal line are going to be the rate distance or really the delta versus the HELOC or the HELoan product. So if you kind of look at the product distribution that's going to be in the black, purple, and the teal bar at the bottom, that's going to be through any point in time what that rate environment looked like as compared to a cash out product, and what the distribution of, say, the quote unquote cash out products of where those originations are attributing to. So it's kind of go to the far right there, kind of middle to far right. Really what you're looking at is consumers made the right choice when rates were sitting in the upper 2 range to low 3 handle range. Home equity became a very small portion of the cash out opportunity. Consumers are locking in long-term money at super low interest rates, and home equity really took a backseat to a lot of the cash out conversations. I, for one, did the same thing. Home equity wasn't on my radar. And yeah, if I can do 3% and refinance my credit card debt and my HELOC debt and my mortgage debt all at once, that's making the better decision for my long-term goals. But what's interesting is as the rate environment started to shift, you kind of see that that blue line up at the top start to dip down. There was a very small moment in time where the average HELOC rate was a better alternative to the mortgage rate. And at the same time, at the very bottom, you see the distribution start to shift more towards HELOC. Consumers are saying, wait a second, HELOC is a better rate, and at the same time, I'm sitting on a 2 or a 3% first mortgage. This makes more sense for me just to leverage a second lien or a junior lien HELOC product, or even a home equity loan product versus my mortgage, doing a mortgage cash out. And finally, to kind of look at the far right side, the tail here, it's a continued persisting movement towards home equity that's now making up approximately 80% of all cash out transactions. But what's different today? We're now sitting at approximately 200 basis points higher than a mortgage cash out rate. So you're thinking this completely does not align with what you talked about earlier, which is when there's a rate differential between home equity and mortgage cash out, you're going to see more mortgage cash out. But you have to think about the millions of homeowners that refinanced in 2000, 2021, early part of 22, and that are sitting at such a lucrative position. They'd be crazy to give up a 2 or 3% rate at this point and refinance into a 6-handle first mortgage rate. So although there is a huge rate differential, again, what's driving this are the millions of homeowners that are making what I would consider a more intelligent choice for kind of long-term goals to secure that money and what they have in a first, and leverage the equity they built up in their home into a junior lien product.
Yeah, that's great. Makes perfect sense. And you can see the rationale behind all of that. So that's, with regard to rates and the rate decisions that consumers are making, totally get it. But, moving to the lenders and kind of their response to it, do they go for, try to tackle the purchase market? Do they go all in on home equity? Rich, what are you seeing as far as kind of lender responsiveness? I know we got a lot of ground to cover, but I want to make sure that we hear kind of what you and your large team across that covers the United States from coast to coast, what are they hearing as far as lender reactions to the market and kind of this, what Ken's talking about here?
Certainly. Well, just to add to what Ken said, it's really interesting because in the past, home equity had really been a great counter-cyclical product offering compared to first mortgage, and that kind of yin and yang between refinance, cash out, and home equity. What we're really seeing across the market is that it really depends. So it's a terrible answer, but the lender, the type of lender really drives what's happening in the market. We are seeing some of our what I'd call traditional consumer bankers continuing to produce home equity loans as part of their overall real estate lending strategy. We're seeing some independent mortgage bankers considering getting into home equity or starting to get into home equity, both on the line of credit as well as installment loans. And then I think universally, though, we're still seeing a little bit of a reluctance to jump in to that market. Again, talking about some of that 200 pip spread has really still impacted, I think, the actual lending volume coming. But we know it's out there, and we know that demand is out there as well for the reasons that Ken mentioned.
And we've talked about the hurdles a little bit, in some of various circles, some of the hurdles about moving to home equity and what that means. So we'll hit that in just a minute here. But I think one of the hurdles is, and Rich, you've mentioned this a couple of times. Before we move on, I know we got a slide here to talk about with some stats on it, but Rich, I wanted to kind of hit on those hurdles real quick about how hard it is to pivot sometimes from one product type to another. So if you can hit that real quick, and then we'll turn it over to Ken and talk about this a little bit.
Certainly. Well, in addition to responding to the unparalleled change in interest rates, the first and only time that we've seen so far where interest rates have almost doubled in less than 90 days, still puts a lot of shockwaves through the system. And as lenders look to retool and redeploy their resources into a home equity origination, they're really seeing a few things that are impacting that. One is the type of product that's out there, the familiarity of their loan officers and processors with a home equity transaction, but more tactically, really the technology issues have become a major obstacle as well. A number of mortgage origination systems were not necessarily supportive of all home equity types of loans. And some of the consumer lending and larger banks have older loan origination systems that make it very difficult to shift and to really pivot into a different type of transaction. So as a result, they're seeing that they're sometimes behind some of the newer entrants. We're seeing some fintechs that have entered into the space and have done the home equity transaction more like a consumer lending transaction than a real estate / mortgage transaction.
Yeah, which would give them a definite advantage. So, yeah, that kind of talks to this, sort of leads us to this slide. Ken, do you want to talk us through this?
Yeah, so interesting to hear kind of Rich's perspective there from the technology standpoint. And one way we thought we would help visualize this is lenders shift into more a technology forward home equity environment. And to help display that, what we're looking at here is all of our historical lender data that's broken out between 3 channels. And I'm just going to focus on the 2. The black bar is going to be representative of centralized origination. So think of this as your non-branch. It's going to be primarily dominant on like the digital space or .com. And then the purple or the blue is going to be decentralized. So think of that as brick and mortar branch originations. So think about what happened since 2010 and really stayed mostly flat until about 2016 is the majority of originations staying in a decentralized model, very branch dependent. Fast forward to 2020, well, we all know what happened. Branches started to shut down. Customers weren't going into branches because of obvious reasons. And very quickly, lenders had to very quickly pivot to figure out what technology do we have today to keep the home equity engine running. And so you saw a very quick shift going from under 30%, so less than a third of their originations, to over a third of their originations as of 2020, going through that centralized or quote unquote digital type of model. And really what we've seen since then is a very escalated pattern of lenders didn't go back once branches opened up. They continued to invest very heavily in technology to create a better environment, a better customer experience. You don't have to depend on branches. They're now competing with a lot of fintechs in the market that have kind of a really sleek end-to-end origination process. So bringing us to present day, it's over 50% of home equity originations now being originated through a centralized model, becoming less dependent on branches and really trying to be as much of a technology forward shop as possible.
That's great. And so, yeah.
Hey, Marvin, if I could just real quick to build on what Ken mentioned too, that as the lenders are looking at that, a lot of that is driving the consumer behavior because consumers are expecting a quicker response for a home equity type of product. And I think that adds a little bit to that hurdle is trying to work through the process of the workflow because the workflow is slightly different as well.
Yeah, and that leads to this next one is on the cycle times. It's a perfect segue, Rich. Talking about the cycle times, and I know we don't, have a lot of time to go on each slide, but the cycle time here is really a story. It's kind of astonishing to see it. So can you lay it out, and then Rich and I'll kind of add into it.
Yeah, absolutely. I'll be brief here, but I think if anyone's looking at this saying, wow, those are pretty good cycle times in home equity, no one's happy with cycle times. So this is really the biggest challenge that I see for a lot of lenders is you're investing in the digital piece, you're investing in technology, but we really haven't seen anything from a breakout standpoint of how is this improving your customer experience? How is this improving your total app to book cycle time to give that customer a seamless experience from digital application to a digital closing, a remote notary closing that allows them to have a speedier access to that available equity in their home. Going back to kind of where Rich was saying, this is a huge hurdle and a challenge because as you see all the different competing products up there, unsecured stands out like a sore thumb, a huge delta between the ease of process and the speediness of getting cash access. What we don't want to have happen is customers defaulting to a less lucrative product from the bank perspective because I can get that money in a fraction of the time.
Yeah, and Rich, I'm sure you have a couple of things to say about this. It is kind of astonishing. And just real quick, I was on the phone with someone today, and we were talking about that. One of the GSE comments about origination costs too. And so the comment was, we've done such a good job on implementing technology over the past few years that the cost of origination has doubled. And I think we're seeing a lot of the cost in home equity as well. And the cycle times are there. So, these hurdles really just don't have to be there, but we're still seeing them today. So question 3 here, I think, is a good one. Rich, Stuart does a lot of this work. I mean, we have pretty much an end-to-end solution suite for this kind of thing. And these hurdles exist today. So, here we are looking at people who maybe are disadvantaged, have lower credit scores and things, but this is an area that is often underserved. Ken, I'm going to let you go first, but I do want to get into the solutions. If a lender says, how can I, really do home equity loans in under 40 days, which shouldn't be a tough bar, how can we do it? So Ken, if you'll lead off with this, and then we'll go into kind of talking a little bit more about solutions.
Yeah, absolutely. So to be brief with this, is what this is looking at is the application demand. And you could take this a couple of different ways, but to kind of bring it forward to what we're talking about today is lenders are faced with a growing number of challenges in home equity, one of which is there's been a shift in who's actively demanding access to the equity in their home. It's predominantly your super prime, your 750 plus credit customers that makes up the big black and blue bar there. But what we're seeing on the top there is a shift in that distribution of lower credit tier borrowers, the borrowers that have equity in their home, but at the same time, credit is not as widely available, and lenders have really not opened up their credit box because of a lot of the macroeconomic uncertainty that's looming. How I'm tying that in is it creates a challenge of, what are you going to do about this? Are you going to address it? Or are you going to let it impact your pull-through rates? Instead of going from a 50% pull-through rate, are you going to accept the fact that you're going to drop to a 35% pull-through rate because you're not addressing the shift in the demand? How is this impacting your origination costs now that you're not booking as much as what's coming in through the door in applications?
Yeah, and then that leads into the next one. You talked about pull through several times, and when you see this chart here, it's pretty telling.
Yeah, so on the left-hand side, that's on HELOC. It doesn't look as severe, but you think about, on average, a 13% decline in roughly the last 12 months or so in average pull-through rates. On the right-hand side, whole different can of worms, but home equity loans have seen a tremendous drop-off from the average pull-through rates, and those are apps that come into the door, the ones that actually close. I mean, this is real dollars. This is real expense dollars and origination costs that lenders need to address and figure out how are they going to shift in either their credit box approach or how they're going to become more dynamic and address the challenge of increasing origination costs to become more efficient.
So I'm going to summarize what I'm hearing, and then Rich, I'm going to ask you to kind of talk about some of the solutions. What I'm hearing is, we know that home equity loans of any type are smaller dollar amounts. We see that the costs are still pretty high. We see that the turn times the cycle times are still long. And now we see that the pull-through performance is deteriorating. So a super challenging time for lenders wanting to play the home equity game. So Rich, I'm gonna turn it over to you and on this next slide and have you talk about kind of how we help lenders, how we help them get there.
Certainly. Well, as you saw on the previous slide about the decrease in pull through, that's material. It's cost. It's actual hard cost as well as opportunity cost. So really, an effective home equity strategy can start by looking at if you have a portfolio of loans, looking at the right candidates to identify. So Ken mentioned about the credit quality. You've also got some LTV considerations, and then you've got to kind of match that, I think, with the investors that you have in play for the different home equity products that you might be offering. And then looking at that first, that pool, that's going to help to drive better conversion and make your efforts more rewarded with loans that will actually close. Next step would really be to look at the process, and typically the process has been somewhat disjointed. There are a number of great providers out there in different components, in credit, collateral, capacity, all very important factors in the underwriting process. But really try to look for a partner who can offer a number of different services, from the beginning and lead generation all the way through the underwriting and application process, and into the actual fulfillment, loan closing, and even post-closing. There are service providers out there that do a number of different services and have also been specializing in home equity, which is different than refinance, as you may know. And then there's also the whole idea of being able to match your product usage with risk and with your type of loan. So there are ways to reduce cost and reduce the time required based on the products you're using in the underwriting process. Kind of like you might consider a product waterfall. Start out with a simpler product that matches a lower risk loan, and then default almost to a traditional refinance process in some cases, or a higher dollar amount at a lower credit tier.
Yeah, there's so much opportunity for savings, but it's we've got to get. I think everybody's got to get out of this mindset of the first mortgage model and really get into a different model where thinking more like a fintech. What tools are available, like the waterfalls you mentioned, and there are waterfalls available for credit, for verifications, for valuation, even for title, to make sure that the right product is in the right place at the right time and not overspending as a lender on products you don't need, which we see in the marketplace today. So thanks, Rich. So I'm going to go on to, we got a few minutes left here. Question 4 is really around the product suite and, what tools are available. I'm just going to touch on this a little bit. We developed at Stewart the Home Acuity Suite, and this is really taking everything we have with all the companies that we've acquired and brought into the Stewart Lender Services family. We have everything from data, all the customer acquisition tools, to really narrow down who are those people who would be good candidates. We have all of the consumer experience tools, which is everything from point of sale all the way through the consumer portal that we have, that gives a very polished experience and a 50% improvement in turn time for the consumer to turn in their documents. We have all the credit tools available through our waterfall that we can do. We have all the valuation tools through Stewart Valuation Intelligence, which is another TMC partner. And they have everything from the smallest AVM all the way up to the most full appraisal, so you're never overspending on anything you need. We have all the title tools, and this is one of the things that is really interesting, Rich, is we find lenders coming to us looking for full title policies when really for home equity, especially at lower dollar amounts, just a simple property report will do. And we have the MSP coverage. I'll ask you to talk about the MSP coverage a little bit here in just a moment, but that allows for a faster title decision. We have all the signing solutions, whether it's a RON solution or whether it's in-person electronic notarization, so that you have a very digital experience, or just a simple branch signing with any of the hundreds of branches across the country that we have at Stewart. And then, of course, we have all the integrations with all the popular LOSs. So really, it's a full suite. You can almost sit down in one of our technology discovery workshops that Rich you can put together. I know you've done those. And so we can put those together where really we're answering those questions. How can I do home equity better? So this is just a quick run through of very high level. We're going to be putting together a Stewart Home Acuity webinar series coming up where we'll dive into each one of these very specifically with all of our internal experts. So if you want to know more about home equity in a deep way, reach out to Rich and he can get you the information on the Home Acuity webinar series we're going to be doing. So real quick before I do that, Rich, if you can just talk about anything either that I missed here or kind of hit that policy, because I know lenders as a migrator sometimes looking for a policy, maybe talk about that policy for home equity a little bit.
Certainly. Yeah. Thanks, Marvin. And great way to tee that up. So as Marvin mentioned, Home Acuity is really designed with the home equity lender in mind. What I would say is as you go out in the market and look for a provider that does multiple services, look for their length of time in the industry, and not only in mortgage lending, but in home equity lending specifically. Evaluate the different types of products that are offered to make sure that you can match time, cost, and risk for your loan, your process, and your loan product. And then also look at things that are important and impactful to your customer experience. Your borrowers have certain expectations, and you want to make sure that your service providers can match that. But before you start looking at the process, I will also say that look for a partner like Curinos who can provide some extra data and analytics, give you the facts and some of the real hard information that you're going to need to be able to make the sound decisions that you need to jump into the home equity market.
Good. Thanks, Rich. And with just a couple of minutes left, I want you to each talk. I mean, you have kind of a little bit along the way, but I want to make sure that we have a good understanding for everybody of what your companies can offer. So Ken, do you want to talk about Curinos in a little more depth as far as kind of what your services are, who the company is and what your services are? Oh, Ken, you're on mute. I think we lost your audio. Okay, I'm going to come back to you, Ken, while you iron that out. So Rich, can you just kind of hit the highlights, a little bit about Stewart, and then a little bit about, the technology discovery workshops and how we can help folks?
Certainly. So Stewart is as most people are aware, a large title underwriter, one of the top national underwriters, also a very extensive traditional title brick and mortar structure around the country. Our lender services group works with lenders across the country in mortgage origination, home equity origination, servicing, and capital markets. Really, we try to leverage the integrations that we have and the different product set that we have for a true high-level customer experience for you and for your borrowers. So I would welcome anyone to contact me and happy to talk through more some of the strategies that we're seeing in the home equity space in particular. Thanks,
Rich. Ken, did we get you back?
Can you hear me?
Yeah, there you go.
Okay, perfect. So to be brief, if you're not familiar with the Curinos brand, we're the coming together of Legacy Icon Analytics, Novantas, and Informa FBX. And really what that means to you is we're kind of a collection of brands, but we bring together 30 plus years of financial services data. In particular, I work specifically with our home equity partners. So we're collecting real-time market data, just like you saw in the earlier slides, where it's real-time data. It's not age data that you might get from some other sources. Where just like Rich was explaining with Stewart, is going to have the data from the vendor piece, where we have the market data to help you price more intelligently, to associate your risk and risk diversify your portfolio. And really look at, what's the market temperature? Am I gaining the appropriate market share for my footprint and based upon my strategy? We'd love to talk more about it and appreciate the opportunity to share some of those insights and how we're able to partner together with folks like Stewart Title and TMC.
Great. Thanks so much, Ken. And I'm going to put your contact information up here. It's on the screen. Encourage anybody who wants to learn more to reach out to either one of you. But Rich, are you going to be at the TMC Nashville event?
I wouldn't miss it for the world.
Okay, excellent. And Ken, are you going to be there?
I believe we'll be there.
Excellent. Okay, so great way to sit down and take this conversation to the next level if you don't do it beforehand. We encourage you to reach out. Stewart is going to be putting on the Stewart Home Acuity webinar series shortly. We don't have all the dates lined up yet, but Rich can get those for you as soon as they're available. So definitely reach out there. And it'd be great to sit down with anyone who wants to do one of the technology discovery workshops. And I like to say, maybe it's a little bit too much, but how can you be a fintech by Friday? The tools are there, and you can definitely put them to use for you. Make your vendors line up and do the work that they can, so that you don't have to make it such a heavy lift on your side as a lender with integrations and such. So, Rich, any final words?
No, thanks very much, Marvin, and really appreciate Ken and all the work that you did in putting this together. Tony, as always, thanks for being a great host, and thank you to TMC for helping us put this on.
Great. Thanks so much, everyone. Really appreciate your time for being here today, and would love to talk to you further.
Excellent. Thanks, guys. We did have one question come in, so I want to give it just a minute. So the trend towards centralizing a centralized origination model supports the ideal condition for consumer-generated RON. So in the RON, in the HELOC space, do you see a lot of closings via RON or the remote online?
Rich, I'm going to pitch that one to you. I haven't been as closely involved in the RON space for HELOCs. Are you seeing that, Rich?
We're seeing some adoption. Again, I think has been somewhat stunted by the time it takes to incorporate a RON transaction universally. So unfortunately, there's still not as much as there should be. I will say, and I agree with you that centralized trend and also the digital trend is making it more of an option. And definitely there have been a number of our clients who have embedded that as part of as an option. So you could use a branch closing, or you could do a mobile notary closing, or you could do a hybrid or RON, and that's definitely part of the fulfillment process.
Yeah, great points. And we offer our Stewart remote choice option where we incorporate all of those together, so a lender doesn't have to pick and choose and have partners work with each other. So we have it all under the Stewart umbrella where we own those. But even then, I would say, it's a learning curve for home equity lenders to, many of them are community-based and branch-based, to really understand how RON fits into all that. So I think it's coming, but I think it's still an education process. But with Stewart Remote Choice, we're seeing that there is adoption. So.
Thanks so much. Appreciate it. That was the one question that we had from the audience. So Tim Anderson, appreciate you sending that in. And thank you guys. Well polished, great information. Could not say anything more stellar than Stewart and Truant. You guys are fantastic partners, and we really appreciate you being part of the TMC network. So thanks, guys.
Great. Thanks so much, Tony. Thanks, everyone.
Appreciate it.
Thanks, everyone.
Have a great day. Bye-bye.